Hey, what is going on, guys? My name is Nick, and yes, I seriously just put myself into $10,000 of debt so I could invest in the stock market. But despite what you may be thinking, this strategy actually doesn't involve that much risk at all, and over the long term, it does have quite a bit of upside potential. Now, in this video, I'll be sharing how I got that $10,000 worth of debt and at what interest rate, why I made this move, and then the pros and the cons of investing using debt. So if you do enjoy this video, make sure to drop a like for all of my transparency, and hopefully you guys can take away something to help your own investing journey. But also, if you haven't already, definitely consider subscribing, guys, because I'm posting out tons of investing content over the coming weeks and months, so definitely stay tuned. But with that said, let's get right into my $10,000 worth of debt. Alright, so the first thing that comes to mind whenever you hear the words debt and stock market put together is margin investing. This is where your brokerage might offer you to open up a margin account, allowing you to borrow money to invest at a specified interest rate. Now, this is super convenient because you don't need to apply for a loan or anything like that. All of the money that you need to borrow is available straight from your trading account. However, with a margin account, you always need to maintain a certain amount of equity within your account, meaning the money that you own yourself. Otherwise, you're at risk of a margin call. When a margin call happens, the brokerage will tell you to go fund your account to raise your equity position within a short period of time. Otherwise, they'll sell your stocks, oftentimes at a loss, just to protect themselves. Now, as fun as all of this sounds, I told myself a very long time ago that I would never put myself in a position where I wasn't in control of my assets, meaning that the brokerage could just sell my stocks at a loss or whenever they wanted to. So instead of using margin, I decided to take out a loan to borrow some money using my personal line of credit. Now, for those of you who aren't aware, a line of credit is just a revolving credit facility, just like a credit card, but at a much lower annual interest rate, and you never have to pay down the balance like a mortgage. You only have to pay the monthly interest payments. Anyways, this all started for me a few months ago when I got an offer from Scotiabank for a personal line of credit because I've been a customer of theirs for a few years now and they just wanted to offer me one. They offered me a $5,000 line of credit at an interest rate of prime plus 4.05%, which in total would be 6.5% annual interest. Now, when I first saw this, I knew immediately that 6.5% interest is way too high to be investing in the stock market, because think about it, you have to earn at least a 6.5% return on your investment each year just to be able to break even. So anyways, fast forward a few months later, I actually got another offer, but from Tangerine Bank online, and this is my go-to bank because they pay a lot of interest and they have no fees. So Tangerine offered me a $10,000 line of credit at an interest rate of prime plus 0%, which in total was just the prime rate, which is currently 2.45% annual interest, which would only be $245 per year or around $20 per month in total interest. Now, this is certainly a lot better, and ironically, Scotiabank actually owns Tangerine Bank, so I'm not too sure why Tangerine has such a lower interest rate on their line of credit. Maybe it's because the online banks don't have a lot of overhead costs and it's just a lot cheaper to operate, so they can offer these lower interest rates. But let me know in the comments down below if you have any idea. I'd love to know. Anyways, in my opinion, 2.45% interest is incredibly cheap money that I would certainly be able to beat over the next few years just by investing in the stock market quite conservatively, even if I were to invest just in blue chip conservative stocks. Now, even though the interest rate will fluctuate according to the Bank of Canada's prime rate, I still think it's worth it while interest rates are so low. So now I'll be getting into some of the pros and the cons of borrowing money to invest to help you figure out if this is something you should ever consider doing. Alright, so let's first start off with the pros of using debt to invest. First and most importantly, borrowing money to invest will allow you to amplify your returns over time. Hypothetically, let's just consider that I have a stock portfolio worth about $25,000, and on average in the first year, I make a 10% return, which gives me an average profit of $2,500 in the first year. Well, if I borrowed an additional $10,000 on top of this original $25,000, I'd then have $35,000 as my total invested capital, and by making a 10% return on this total invested capital, I would then make a profit of $3,500. But since I don't own that extra $10,000, I would actually calculate my return on investment based on the original $25,000 that I had in my brokerage account. So by taking the total profit of $3,500 divided by the $25,000 that I originally had, this would give me a total return on investment of 14%. Now, of course, I'm not accounting for any interest or any fees on this extra $10,000, so that's definitely something you need to consider. But had I only invested that original $25,000, I would have only made a 10% return at the end of the day, being a profit of $2,500. So anyways, borrowing to invest when you're confident in the potential returns you might achieve can be a great way to boost your profits in the long run. Getting into the second pro here, while it is unpleasant thinking about an investment going poorly, it is possible to claim capital losses to reduce your income tax bill at the end of the year if you do lose money in your investment. For example, let's say that I invested in CCL stock right before the pandemic with the $10,000 that I borrowed, but then the stock tanks 50% as it did, and I decide to sell. Well, this means that I'd be taking a $5,000 loss on my investment, but at the end of the year, this means that I would be able to claim capital losses on my income tax return and actually reduce the amount of capital losses that I would have. Now, it should be noted that this strategy only works if your funds are not in a registered account over here in Canada, such as a TFSA or RRSP, which is why I'm choosing to invest in a margin/cash account, and there's nothing registered about it, so you can claim those capital losses. Anyways, continuing with our example, let's assume that I'm in a 30% tax bracket. So we would first divide the capital loss by 2 because just like capital gains, capital losses are taxed at 50% of your normal tax rate, so that would leave us with $2,500. Then by multiplying that $2,500 by my 30% tax rate, this would give me $750 that I would be able to deduct from current or future capital gains taxes. So I know it's really not that much, it's only 15% in this example, but at the end of the day, it does help out if you're needing to repay that debt for some reason, or just being able to handle the pain of a loss. Thirdly, borrowing money to invest allows you to keep more cash at the end of the day in your bank accounts. When I decided to borrow this $10,000 of debt to invest, it does not mean that I had a $0 bank account balance. Rather, borrowing allows me to keep more money in my bank account at the end of the day for daily and monthly expenses that might come up, while being able to invest the equivalent amount. I think it's incredibly important to always have an emergency fund or some cash on the sideline just in case something expensive comes up in your life, like a car repair or a home repair or whatever like this, or in case you have some other opportunity to invest. This way I'm able to alleviate another $10,000 of savings for my emergency fund while being able to invest the equivalent amount at a very cheap interest rate, which after inflation is essentially next to nothing. Just think of your own personal finances like you would a company. Does a wonderful business ever have no cash on their balance sheet even if they have debt? No way. Even companies like Facebook, Google, and Apple all take out debt to invest even though they have the cash to pay it off on their balance sheets because it's the smartest financial move to make. Overall, maintaining cash in your bank account is very important for those unexpected expenses that might come up. Fourth and finally, guys, by borrowing this $10,000 via my personal line of credit, I'm not on the hook for any margin requirements within my brokerage account. Frankly, it really doesn't matter what I do with this money that I've borrowed or what the value of my investments are over the short term. The only thing that matters when you have money borrowed on a line of credit is, are you able to make those interest payments? So based on the $10,000 that I borrowed, my total annual interest payment would be $245, which is very cheap. And then on a monthly basis, this would be $20.40, which under my own circumstances, I can easily pay going forward. Overall, just knowing that I have no margin requirements gives me peace of mind by taking out this debt to invest, and it helps me have more of a long-term focus on the investments. All right, but now let's get into some of the cons of using debt to invest. The first and most obvious con is the increased risk. Investing with debt can increase the risk of you losing money if an investment doesn't pan out the way you had hoped. When borrowing money, it's very important to remember that you're always obligated to pay back the full amount once you're done using that debt at some point in the future, along with all of the interest payments that they charge you. So in the event that you do lose money on an investment, you're going to have to find some way to make up that money again to pay back the bank. This could be through selling some other stocks or real estate, or by saving up just like you did for your emergency fund, or pulling out of your emergency fund and just paying back the bank. So it's extremely important to choose your investments wisely before you start investing with borrowed funds. Just don't be taking massive risks, guys. Invest in companies with growing revenue, growing earnings, and trading at a reasonable or undervalued price in the market. And that's exactly what I plan on doing to be able to preserve my capital first and foremost, but then also make some returns on it over the next few years. Secondly, borrowing to invest can lead to increased costs. Whenever you borrow money to invest, you're always going to have to pay a little bit of interest on it. As a result, this ends up costing you more in monthly expenses that you should always be accounting for in advance. For example, in my own scenario, I'm going to have to pay an additional $20.40 per month just to be able to afford this debt, which I know is completely reasonable under my own circumstances. But everyone's situation is always different, and if the interest payment is too high, it might not make sense to borrow money to invest at this point in your life. That's why I believe it's best to only invest borrowed money if the interest rate is below 3% in today's market, which in my case, it's 2.45%, so I'm happy with that. Overall, I feel that at my stage in life, being 25 years old, the benefits outweigh the risks in terms of using a line of credit to be able to invest at an interest rate of only 2.45%. However, as the interest rate does change over time because it is a variable rate, I will be reevaluating my position because it might not make sense to continue investing using this debt if the interest rate is too high. But for now, I'm happy with the current rate and I'm not too concerned about it over the next few years at least. But anyways, I'd love to hear your thoughts on the topic of using debt to invest in the stock market because I feel like it's a topic that not many investors feel comfortable talking about, so I thought I'd open up the conversation with this video. And of course, if you did enjoy this video, make sure to drop a like for all of the transparency and the thoughts that I gave you. Also, if you haven't already, definitely consider subscribing for more investing content coming out of my channel very, very soon. And with that said, I will see you guys in the next one.